Hello everyone, my name is John Locke. I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you're aware of all your risks prior to placing any trades. Also note that in this presentation, we are covering hypothetical computer simulated trades and results. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance success coach and wealth coach with Locke in Your Success LLC. And myself and my team are here to help you win in the markets and in life as well. And we're about to take you into the realm of high probability options trading, also known as income trading. This is where we utilize complex options strategies to make use or benefit from the passage of time rather than relying solely on price movement in order to make money. This means we can often make money whether the price goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it is an indication that we're much more likely to win than we would be if we were depending on price movement alone in order to make money. The trading strategy that I'd like to share with you today is something called an X4 version 17. Now, the X4 version 17 is a high probability, positive theta, broken wing butterfly strategy that we trade on the SPX or the S&P 500. The strategy itself at minimum size requires a minimum of $3,500 per trade. The example size we're going to be showing you today is a $35,000 planned capital trade. And the risk parameters on this is our exit loss trigger, or some people call it a stop loss, or the point at which we're going to exit the trade if it goes poorly, is going to be a drawdown of 7.1% of our planned capital. In this case, it's going to be $2,500. And as far as a profit target, this particular strategy does not have a profit target. We're going to exit it at a certain date. So we'll go over that as we move along. Okay, so the trade I'm going to show you today is the December expiration X4 version 17. The software that we're taking a look at here today, this is called OptionNet Explorer. This is a software that will show you your risk profile on the graph here. So let me just zoom this in a little bit. What we have here is the value of our position at expiration at any given price point. Our profit and loss goes up the side here. We have this, like I said, this triangular shaped line, which is the value of the position at expiration if we don't do anything to the position and we let it expire. And then we have our thinner line here that's more curved. That's known as a T+0 line, or the value of the position or the profit and loss in the position as of today, and the estimated profit and loss with price movements in our assets. So, for example, right now the S&P is at 43.57. If that were to come down to 42.50, this position would be down, or it's projected it would be down about $2,049. If we were going to run up to here to say 4,500, it's projected the position would be up 1674. That's of today, as of today. As time passes by, you get something that looks like this. And the T+0 line gets more and more shaped like our expiration graph as time goes by. Eventually, it will be shaped exactly like our expiration graph. So let me just put this back down to one projection line and just explain over here. Over here, we have our date and time. This was not the entry time, so let me jump back into a proper time. This is our entry time, and here is our expiration cycles. So this is the expiration cycle, the 17th of December, 2021. Up here we have our asset price, so our last price here was 43.65. Down the left side here, we have the strikes of the various options that are available. We have the calls on the top, the puts on the bottom. For this particular strategy, I like to use all put strikes. And the way that it's entered is we take our asset price, which is 43.65. We sell approximately 20 points under the money. That's going to put us at 43.40. We're going to do a 60-point downwing, give us long strikes at 42.80, and 40-point upwings give us a some long strikes at 43.80 here. This order would be put in all at once. It's called a broken wing butterfly. So if you have a broker that is friendly to options trading, they should have a broken wing butterfly option. You can put that in there and do that in one shot. Now, what this analytical graph is telling us right now is, as the position currently is, we have a little over $15,000 in the position. We have a high potential profit here if you were to expire it of about 42,000, which we're not going to do. We don't let this trade go that long. And then if we go to the upside and we make no adjustments, the win on this would be, or should be, close to $5,000. So that's basically what that's telling us here. Along the bottom, we have profit and loss. We're down $40 on entry due to commissions and so forth. And this software does include commissions. So I'm asked that a lot. Also, we have the other important thing here is our delta. We do use this number for adjustment decisions at times. So let's just kind of get moving here, and we'll talk about this along the way. This is our entry position. You'll notice on entry position, this position happens to be 15.24. This for delta. This position will change in drastically different implied volatility environments, but for this particular entry, this is fine. And if the market price goes down, we're going to do something called an adjustment here. So that adjustment takes place if we exceed the short strikes to the downside. So you can see the short strikes are at the 43.40. So if our asset price comes down under 43.40, we're going to what we call roll this back or exit reposition. To the upside, we don't adjust till we get negative delta. And it is possible that this may get negative delta, but it's not very likely given the actual entry on this particular cycle. So let's see how it goes. So we start out 77 days to expiration, October 1st, 2021. I'm going to just hop into the first adjustment here. And that happens only 3 days later. So we got in October 1st, which is actually one trading day, the very next trading day. So very poor entry timing, right? So we got in this day here on October 1st. And the very first trading day, we get a very large down move. That's going to produce a drawdown for us. And it also is going to trigger an adjustment because we're underneath this level here. Now, you might say, oh, you should have adjusted it back here when it went under the short strikes. And the answer to that is no, I shouldn't have. One of the things that we like about our types of strategies is we're not looking at these intraday or looking at them all day. It allows us the flexibility to not be watching the market. As a matter of fact, we recommend you do not watch the market. We simply take a look at this position at a predetermined checkpoint time, in this case, 15:30, which is 3:30 in the afternoon or Eastern time, or half an hour before market close. And we take a look at the position, and if we need to do something, that's fine, we do it. If we don't need to do anything, we leave it alone. So in this case here, we do want to do something, and we're simply going to exit this and reposition it. So you can see that the asset price is at 42.95. We go about 20 points under that. We're going to be looking at 42.70 for short strikes. So we're going to sell this, and this can be sold in one order. And we're going to buy our 42.70s. Same setup, 60-point lower wing, 40-point upper wing. Put it in as one order, get it executed, and this is our positioning. So from here, let's go day by day for a little while. So the following day, we get an up move. We're back to just about break even or where we were on entry. Let's go a week at a time because this is a longer term trade here. I'm just going to pop ahead 2 weeks. 2 weeks later, this is where we are. We can see that the market did what we call a capitulation here off of this down move and didn't require any further down adjustments. And now we've taken off to the upside, as the market has been doing so commonly in the last year or two. We've had these pretty severe down moves like we just saw there, but most of the time or historically, we've bottomed and had just a crazy up move. So that is the case once again here, which is one of the reasons the strategy has been doing extremely well. And then what I'm going to do here is let's just go 2 weeks further ahead. I don't think there were any other adjustments at this point. Once something like that happens, you tend to be in the clear. If we get to November 5th, here we are, and we're up $3,080. And from there, let's just pop ahead another 2 weeks. Now we're up 3280, and let's go another 2. It looks like I've already exited. So let's go back here. This is the trade right here. We're currently 17 days to expiration. So this trade is doing well. Of course, we are having a really big down move at this point. But despite the fact we just had an 80-point down move in the SPX, we're still doing really, really well here. So let me actually go back one day here. This is what we looked like the day previous. We're up 33.30. If I go one more day here, again, we got that 80-point plus down, or almost 80-point down move here. And yes, that's going to beat up on your profits a little bit, but it's certainly not the end of the world. Let's look at the price chart. So this is what happened. We got hit with a down move on entry. We had to roll back. We had just a crazy up move after that. Ran sideways for a while, and now we're pulling back. And it's going to handle, position this way, it's going to handle this pullback really, really well. Let's see, we're 17 days to expiration. The exit of this trade is when we hit our exit loss trigger of minus $2,500, or we hit the point where the cycle 2 months in advance is 77 days to expiration. So as of this Tuesday, you see our February is 80 days to expiration, which means in 3 days, we're going to be exiting this trade here. So let's just go ahead one day. Another 20-point down move, right? 2 days. You get a 75-point up move. Really didn't bother us at all. And then the next day is going to be our exit, because February is 78 days. It's going to be 77 days to expiration. So let me ignore trades. Let me go forward. And we get another 50-point down move. Now this is up money. And of course, if you stayed in the trade, yes, there's a good chance you would end up making more money. That's always a decision you make as a trader. But these are guidelines trades. In other words, they're pretty mechanical here. And we're just entering them according to the date. We're not doing any technical analysis, and we're exiting them at a certain date or at a certain drawdown to keep our risk in check with the strategy. And as you can see, it's extremely simplistic. Yes, 77 days went by. You only had to touch it one time during that whole time, meaning you're not sitting there white knuckling it for days on end when you're trading. It's just, it's a very nice way to trade, actually. I really like it because it's kind of laid back, and I can go out and do things and, pretty much be doing my own thing. And as you can see, 99% of the time, you're really not doing anything with it. And the returns on it tend to be really good. If you take a look at the returns here, this is going to exit at about a $2,580 profit minus the commissions coming out. And that is going to be on our planned capital. That's going to be about probably 7%, a little over, about 7.5% of our planned capital. But if you look at the actual amount of money in the trade, which is the most we got, is only about $17,000. That's a really good return on $17,000, or the actual capital in the trade. So that's one of the reasons I just really love this strategy. And yes, you can actually get sometimes returns much higher than this. It is a long trade. They do overlap. So I also have a January going at the same time, or a November going at the same time, usually when I have the December going on. But again, it's the same thing. They're so hands-free for the most part that pretty easy going in that situation. So anyway, that is the X4 version 17, this episode's winning trade. If you like what you see, I encourage you to come on over to thewinningtrade.com. That's thewinningtrade.com, and discover how you too can follow along with this and many other great strategies during our weekly Options Trading for Income webinars that we hold with our Go membership. Also, where you can learn about upcoming winning trade presentations and stay up to date with the release of our other exciting podcast, the Trading Performance Podcast, where you can learn to skyrocket your trading results regardless of the type of trading you do. If you have any questions or comments or anything else you'd like to see on the next winning trade, I'd love to hear from you. Simply comment on the videos below. I'll make sure I answer your questions for you personally. Thank you for joining me, and I look forward to seeing you on the next winning trade.